Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, thekouk.com, and on Twitter using the handle thekouk. Stephen, did you enjoy last week just a little bit less frantic post-election or not?
No, I did, and well, I acknowledge I'm biased, of course, but I actually got a bit of encouragement about how the Treasurer, Jim Chalmers, and the Finance Minister, Katie Gallagher, were approaching their jobs. Okay, they're going to be playing politics for a while and blaming the coalition for some of their ills. But to be fair, I think they're sort of approaching their new jobs with a bit of gusto and a bit of an attempt to fix things up. So I was sort of encouraged.
I reckon when you've been out of power for 9 years and you finally get the gig, wow, it must be a good feeling.
Yeah, and the temptation is to rush and do everything too. I'm sure that's the case. But obviously, with the things that we were discussing last week and in prior weeks, we've got a situation where, look, the economy's growing nicely, and that's a good thing. But we do have this issue with high inflation, the almost certain interest rate hikes coming down the pike, and the one which is a more structural issue for a treasurer and a finance minister is that repairing the budget. We've got big budget deficits. So, there's a lot they want to do, but approaching it with a steady hand is probably the best approach at this stage.
Now, we'll find out this week exactly how fast the economy is growing, or at least how fast it grew during the March quarter. But some of the data which feeds into that final number, which we get this week, came out last week. The big one being CapEx, capital expenditure.
Yeah, and it was a bit disappointing. It was actually a drop of 0.3%. So the machinery and equipment component grew by around about 1.25%. So that was good. But the buildings and structures was weak. It actually fell in the quarter, which dragged the bottom line CapEx number lower. And when we look at why that occurred, it was because there was some floods, obviously, in southern Queensland, northern New South Wales and other places too, which limited the ability of builders to construct, of course. So that was one reason. And the other reason was COVID, that people were unable to turn up to work because either they had COVID or their family members had COVID. So that lack of hours worked, if you like, in the economy dragged on CapEx as well. So a little bit of a disappointing number, although having said that, the expected level of CapEx for the next financial year, 22-23 financial year, was actually quite positive, up around about 12 or 13%. So that should see something of a rebound, and it supports the pretty decent growth outlook that we've got.
Okay, so we get the economic growth figures this week. What are they going to say, Stephen? Tell us first.
Oh, well, I'll try. They're a bit of a lottery. This last 2 years with COVID and this supply chain disruptions coming through the economy, they've been harder to read. They've been extremely volatile. Like we've had a minus 7%, a minus 3.7, a plus 3.4. Yeah, they've been all over the place. Now, that's my caveat for not shooting me when I get this wrong. But
yeah, you sound like an economist.
I am. But look, it's going to be a softish sort of number that we know, again, as we're just discussing on the CapEx. That was a small drag on GDP. We know that the net export numbers are negative. So while commodity prices are strong, we have had an import surge that, in fact, that equipment investment, most of that is imported. So we're going to have net exports as a negative. Offsetting that, we have really good strength in household spending. We do know that government is still contributing to the economy, that there's still a fair bit of fiscal spending in the pipeline. So cutting to the chase, GDP looks like it's going to be about 0.5% quarter on quarter, about 2.7, 2.8% year on year. So it's an okay growth number. It's consistent with the stuff that we're seeing in the economy and on the labour market as well. So growth's reasonable at this stage.
Okay, a few other figures out this week. It's the end of the month, of course, so we get the CoreLogic house price data.
Yes, and it's going to be interesting because it's going to show that nationwide house prices are down. We do know the data from their daily series, and it's showing that house prices nationwide will be down about 0.3%, perhaps something like that. But amazingly, within that, there's a huge divergence from city to city. So Sydney will be down close to 1% month on month. Melbourne down about 0.5%. That's why the national figure's down. We still have growth occurring in the other capital cities, Brisbane and Adelaide leading the way, and the others, Hobart, Canberra, Darwin, Perth, sort of muddling along reasonably at a slower pace. But, we'll get a few headlines this week saying, the house price boom has ended and, how far will house prices fall? But look, after a boom that we've seen in the last 18 months in prices, a little bit of a pullback's not a bad thing.
Okay, the other one is international trade. We talk so much about international trade on Fear and Greed, not even in using those words, but we talk about commodities and commodity prices. We talk about the big companies, the iron ore companies, selling stuff to overseas buyers. We talk about the exchange rate the whole time. What's happening in that international trade area?
Well, we've seen those commodity prices and good export volumes continuing. And these numbers are for April. We know that commodity prices took another leg higher. Even a lot of agricultural prices, wheat prices are very, very strong. And we've had decent growing seasons. So, look, we're going to get a decent sort of monthly trade surplus, probably around about that 9 or 10 billion monthly number. So we're exporting decent volumes at a high price. And as we just alluded to on that CapEx result, that we are actually starting to import a lot of machinery, equipment and items. And when consumer demand is running along at a decent clip, when we've got business investment also looking to re-equip with machinery and cars and transport vehicles, most of which are imported, of course, you get a bit of a pullback on the size of the trade surplus. But bottom line, the trade position is still favourable to Australia.
And the other one, which I must say I know very little about, but you're always really interesting on it, is the credit data.
Yes. The credit data is split into three main components. Credit for housing, which is the one that we tend to focus on, and that's going to be up again, even though the house prices have come off a bit over the last month. We do know that people are still borrowing and buying and the like. So that's going to be an important indicator of just how strong credit growth is for the housing market. But the other two components are personal credits. Now, that's a much smaller component, of course, but nonetheless, we've had consumers sort of scaling back their personal credit numbers. I think part of that's because they merged them into their mortgages now. So it's a slightly structural issue in terms of how we consumers borrow and spend. But the other one, which is going to be really important, is business credit. So are businesses borrowing money to fund their expected expansion? So I'll probably spend most of my time looking at the business credit numbers with a casting eye on the housing credit numbers too, because if business credit remains strong, it fits with those earlier issues about the expectations for CapEx being pretty good. Yeah. And that's a nice building block for the remainder of this calendar year and into 2023.
Enjoy the week, Stephen.
I will for sure.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.